Stop what you're doing right now. On Saturday, I warned you that ComEx just banned retail silver delivery. I told you they were locking the exits. I told you something much bigger was coming. And overnight, while you slept, the reason revealed itself. The Federal Reserve's balance sheet expanded by $840 billion between Tuesday night and Wednesday morning. They are calling it technical liquidity assistance. That is a lie. It is quantitative easing on steroids. It is a stealth bailout of a magnitude that makes 2008 look restrained, and the entities that banned you from taking silver delivery on Saturday knew this was coming. They locked the doors before they flooded the room. This is John A.G., and if you didn't listen then, you need to listen now. Let me connect the dots because the pattern is so clear that once you see it, you cannot unsee it. Saturday, February 15th, ComEx implements Amendment 724H. Retail traders can no longer take physical silver delivery. Only institutional participants with 100-plus contracts can receive metal. I published that video showing you the regulatory filing, explaining why it mattered, warning you that delivery restrictions signal inventory crisis and system breakdown. Some of you listened. Some of you said it was fear-mongering. Tuesday morning, February 17th, the secured overnight financing rate spikes to 12%. Treasury collateral gets rejected at 3 major clearinghouses. Banks refuse to lend to each other. The plumbing of the financial system has a cardiac arrest. I published that video showing you the repo market seizure, the emergency central bank calls, the stablecoin depeg, the matrix showing green while the blood stopped flowing underneath. And now, Wednesday morning, February 18th, the Federal Reserve's balance sheet shows an $840 billion expansion in 36 hours. That is not a coincidence. That is a sequence. Ban retail delivery, seize the repo market, print $840 billion, and the people who executed that sequence in that order knew exactly what they were doing and why. System collapses don't happen randomly, and neither do bailouts. When you see delivery restrictions followed by market seizures followed by money printing, you are not watching 3 separate events. You are watching 3 stages of the same operation. Stage 1, control physical supply, so that when the printing happens, retail cannot convert paper into metal that holds value. Stage 2, create the crisis that justifies the printing. Stage 3, execute the bailout while calling it something else. Technical liquidity assistance, swap line operations, emergency repo facilities. Every word designed to obscure the reality that the Federal Reserve just created $840 billion in new money in less than 2 days to prevent the banking system from imploding visibly. And the ComEx ban on Saturday was the preparation for this moment. They needed to make sure that when the money printer turned on, you couldn't run to the silver window and demand delivery. Because if retail could take delivery, if millions of ounces flowed out of ComEx in the same week the Fed printed $840 billion, the narrative would be too obvious. The public would see it, bail out the banks, ban the people. So they banned the people first. Here's the intelligence that confirms this was coordinated and not reactive. My source at the New York Fed, someone with direct access to balance sheet operations, sent me data at 7:20 a.m. Eastern this morning. The $840 billion expansion began at 11:47 p.m. Tuesday and executed in tranches through 4:30 a.m. Wednesday. It was not announced. It was not in a press release. It appeared in the H41 statistical release, the weekly accounting of Federal Reserve assets and liabilities that gets published every Thursday. But my source has real-time access to the internal systems, and what those systems show is that $500 billion of that $840 billion went directly to the European Central Bank via emergency dollar swap lines, not to U.S. banks, not to domestic repo operations, to Europe. At 3:30 a.m. Eastern, while Americans slept, the Federal Reserve sent $500 billion to the ECB to prevent a European bank from collapsing before markets opened Wednesday morning. The name of that bank has not been disclosed, but the entities that authorized the swap line know which bank it is. And they made the decision that a visible European bank failure would trigger contagion that could not be contained, so they printed the money to stop it. Let me explain what a dollar swap line is, because if you don't understand the mechanism, you won't understand why this is so significant. The European Central Bank does not print dollars, it prints euros. But European banks often have dollar-denominated liabilities, loans, and obligations that must be paid in US dollars. If a European bank faces a dollar liquidity crisis, meaning it needs dollars to meet obligations and cannot access them in the market, it goes to the ECB. The ECB then activates a swap line with the Federal Reserve. The Fed creates dollars and lends them to the ECB. The ECB lends those dollars to the European Bank. The transaction is temporary, with the expectation that the dollars will be returned when the crisis passes. In theory, this costs U.S. taxpayers nothing because the dollars come back. In practice, swap lines are how the Federal Reserve bails out foreign institutions without calling it a bailout. And $500 billion in swap lines overnight tells you the institution in question was not facing a small liquidity gap. It was facing insolvency. And the only way to prevent that insolvency from becoming public was to flood it with $500 billion before European markets opened. Now let me show you why gold's move to $350 this morning is the market's verdict on what just happened. Gold closed Monday at $2,147 per ounce. Tuesday, during the repo market seizure, it moved to $2,190. Wednesday morning, after the $840 billion print became visible in internal Fed data, gold gapped to $3,150. That is a $260 move in 48 hours, a 9% gain on an asset that is supposed to be a stable store of value. Gold does not move 9% in 2 days because of technical factors or momentum trading. Gold moves 9% in 2 days when the market collectively realizes that the supply of dollars has just increased by nearly $1 trillion in a single week, and that increase was not announced, not debated, not authorized by Congress. It was executed in the middle of the night to prevent a crisis that the public was not told about. Gold is not rallying. Gold is repricing to reflect the debasement that just occurred. Every dollar in existence is now worth less because 840 billion new ones were created. And gold, which cannot be printed, which exists in fixed supply, is adjusting its price to reflect the new reality. Here's the real-time money trail that shows who knew this was coming and positioned before the announcement. Between 9 p.m. Tuesday and 6 a.m. Wednesday, my contacts at 2 major bullion dealers confirmed unusual activity. Large institutional orders for physical gold, 400-ounce bars, quantities measured in tons, executed overnight at premiums significantly above spot. The buyers were not hedge funds trading paper. They were family offices, sovereign wealth entities, and ultra-high net worth individuals taking physical delivery to vaults outside the banking system. These orders were placed before the $840 billion expansion became visible in any public data, which means the buyers had advance knowledge. They knew the Fed was going to print. They knew the ECB was getting swap lines. They knew gold was about to reprice. And they acted on that knowledge while retail investors slept, while financial media ran segments about stock market volatility, while the apparatus of the financial system executed a bailout in the dark. Smart money does not wait for confirmation. Smart money moves on intelligence. And the intelligence said $500 billion was going to Europe and gold was going higher. Let me now connect this back to the silver market because the ComEx ban and the $840 billion print are two sides of the same operation. Silver closed Friday at $98.40 before the ComEx ban. Monday, it gapped to $108.50 on the commercial failure news. Tuesday, during the repo seizure, it held $108. Wednesday morning, with gold breaking $3,150 and the Fed balance sheet expansion confirmed, silver is trading at $119 in early futures. That is a $20 move in less than a week. And more importantly, it is a move that is happening while retail delivery is banned. You cannot take physical silver from ComEx anymore. You can trade the contract, you can settle in cash, but you cannot convert paper into metal, which means the $119 price you see on the screen is not the price of silver. It is the price of a contract that might get you silver if you're an approved institution with 500,000 ounces worth of positions. If you're retail, if you're an individual trying to protect wealth, the price you pay is the dealer premium, and dealer premiums right now are $35 to $45 over spot. So while the screen shows $119, your all-in cost to actually obtain physical silver is $154 to $164. That spread, that $35 to $45 gap between paper and physical, is the market's way of saying the paper price is fiction. Here's why the timing of the ComEx ban relative to the Fed expansion proves this was coordinated. If ComEx had waited until after the $840 billion print to ban retail delivery, the optics would have been catastrophic. The Fed prints money, silver price spikes, retail rushes to take delivery, ComEx bans them. The sequence would have been too obvious. It would have looked like what it is, a wealth transfer where the people who create money protect their positions by preventing the public from accessing the asset that preserves value when money is created. But by banning retail delivery on Saturday, 2 days before the repo seizure, 3 days before the $840 billion expansion, ComEx created plausible deniability. They can say the ban was about market stability, about preventing speculation, about ensuring industrial supply. And the Fed can say the balance sheet expansion was about maintaining financial system functioning, about preventing a credit freeze, about technical liquidity provision. Neither institution has to admit that the ban and the bailout are connected. But the people who understand how these systems work see the connection immediately, control the exits, then flood the system. And if you controlled the exits first, the flood doesn't cause a stampede. Now let me explain why the $840 billion number matters in the context of the unrealized losses I've been tracking for months. U.S. banks have been sitting on approximately $481 billion in unrealized losses on securities portfolios, bonds bought during the zero-rate era that are now underwater because rates rose. Those losses don't show up on income statements as long as the banks don't sell the bonds. But they represent a capital hole, a gap between what the bonds are worth on paper and what they could be sold for in the market. If deposit withdrawals force banks to sell those bonds, the losses become real, capital vanishes, and banks fail. That's what happened to Silicon Valley Bank in March 2023. Tuesday's repo market seizure, where Treasury collateral was rejected and SOFR hit 12%, was the signal that banks were facing exactly that scenario. Deposit stress, collateral rejection, forced liquidation risk. The $840 billion Fed expansion was the solution. Inject enough liquidity that banks don't have to sell underwater bonds. Provide enough dollars through repo and swap lines that institutions can meet obligations without realizing losses. It is a stealth recapitalization. The Fed is not directly buying the bad assets like they did in 2008. They're flooding the system with enough money that the bad assets don't have to be sold. The losses stay unrealized. The banks stay solvent on paper, and the cost of that solvency is borne by every person holding dollars that just got diluted by $840 billion. Here's the European connection that explains why half the money went to the ECB instead of staying domestic. The European banking system has significant exposure to U.S. Treasuries and dollar-denominated assets. When Treasury collateral started getting rejected Tuesday morning, European banks holding those assets faced margin calls they couldn't meet. If a major European bank defaulted on dollar obligations, the contagion would cascade back to U.S. counterparties. The system is interconnected. A failure in Frankfurt affects New York. A failure in Paris affects London. The 3:30 a.m. swap line to the ECB was not charity. It was self-preservation. The Federal Reserve prevented a European bank failure because that failure would have triggered U.S. bank failures through derivative exposure, counterparty chains, and collateral rehypothecation links that span the Atlantic. So they printed $500 billion and sent it to Europe to plug the hole before it became visible. And they did it in the middle of the night because doing it during market hours would have caused panic. The entities that executed that swap line understood that timing was critical. Markets open, people see a European bank fail, confidence collapses, bank runs accelerate globally, markets closed, print the money, inject the liquidity, the bank survives, markets open calm, and the public never knows how close the system came to breaking. Let me show you the 3 stages of the operation laid out in sequence, because once you see it this way, the coordination becomes undeniable. Stage 1, Saturday, February 15th, ComEx bans retail silver delivery. The justification is market stability and ensuring industrial supply. The reality is locking the exits before the flood. Stage 2, Tuesday, February 17th, the repo market seizes. SOFR spikes to 12%. Treasury collateral gets rejected. Banks stop lending to each other. The plumbing breaks visibly enough that emergency central bank intervention is justified, but not so visibly that retail panics. Stage 3, Tuesday night to Wednesday morning, the Fed expands the balance sheet by $840 billion. $500 billion goes to Europe via swap lines. $340 billion stays domestic through repo operations and bank lending facilities. The money flow stabilizes the system. Markets open Wednesday calm. The stock market shows green. The crisis was contained. And the only people who know what just happened are the ones watching Fed balance sheet data in real time and connecting it to the ComEx ban that happened 3 days earlier. Now let me address the question that determines whether you act on this information or dismiss it. Why should you care about an $840 billion Fed balance sheet expansion if the stock market is stable, if the banking system didn't visibly collapse, if your paycheck still clears and your debit card still works? Here's why. Every dollar the Fed creates dilutes every dollar you hold. If there were $100 in existence and the Fed creates 10 more, your dollars are now worth 10% less in real purchasing power. The $840 billion created this week represents approximately 3.5% of the total U.S. money supply, which means everything you own denominated in dollars, your savings, your paycheck, your retirement account, just lost 3.5% of its purchasing power overnight. You didn't feel it because prices don't adjust instantly. Inflation is not immediate. It's a slow erosion, but the debasement happened. And the entities that understand this, the family offices buying physical gold at 3 a.m., the sovereign wealth funds taking delivery of 400-ounce bars, the institutions moving into hard assets outside the banking system, they're not reacting to the debasement. They're front-running it. They're converting paper dollars into things that cannot be printed before the rest of the market realizes what just happened. Here's the forward-looking indicator that tells you whether this $840 billion was the end of the crisis or the beginning of something larger. Watch the Fed's H41 statistical release that gets published every Thursday afternoon. If next Thursday's release shows the balance sheet staying at the elevated level, the $840 billion is permanent. If it shows a reduction, they're unwinding some of the emergency liquidity because the crisis stabilized. My expectation based on historical precedent is that the balance sheet stays elevated or continues expanding. The Fed has never successfully reduced its balance sheet after a crisis expansion without triggering another crisis. They tried in 2018. Markets collapsed in December. They stopped the reduction. They tried in 2022. Regional banks failed in March 2023. They stopped the reduction. The pattern is clear. Once the balance sheet expands, it stays expanded because the system has become dependent on the liquidity. Withdrawing it causes the same problems that justified creating it. So the $840 billion is not temporary technical assistance. It is permanent debasement, and the purchasing power loss is permanent. Let me now show you why gold at $350 is not expensive. It's repricing to the new reality. In 2020, when the Fed expanded its balance sheet from $4 trillion to $7 trillion to respond to COVID, gold moved from $1,500 to $2,070 in a matter of months. That was a 38% gain, reflecting a 75% expansion in the balance sheet. The math wasn't perfect, but the direction was clear. More dollars, higher gold price. Now in February 2026, the Fed just expanded by $840 billion in 36 hours on top of a balance sheet that was already over $7 trillion. Gold's move from $2,147 to $3,150 is a 10% gain, reflecting a 12% balance sheet expansion. The ratio is actually understated compared to 2020, which suggests that either gold is going higher from here as the market fully prices in the debasement, or the Fed is going to print more before this is over. Either way, $3,150 gold is not a bubble. It's a rational repricing of a finite asset whose supply cannot increase, while the supply of dollars just increased by nearly $1 trillion in a week. Here's the asymmetric position that makes sense right now, because this is not about speculation, this is about preservation. Physical gold and silver held outside the banking system in allocated storage or direct possession, not ETFs that hold treasuries in their structure, not futures contracts that might get cash settled, not digital representations, physical metal. The reason is simple. The Fed just proved they will print whatever amount is necessary to prevent visible banking system failure. They did it in 2008, 2020, 2023, and now 2026. The pattern is consistent. Crisis, print, stabilize, repeat. And every time they print, the value of paper assets denominated in the currency being printed declines in real terms. The entities positioned in physical gold before this week's $840 billion expansion are up 10% in 48 hours. Not because they speculated correctly, because they understood the playbook and positioned for the inevitable response. The next crisis, and there will be a next crisis because the system's structural problems were not solved, they were papered over with $840 billion, will trigger the same response, more printing. And the people positioned in assets that cannot be printed will preserve purchasing power while everyone else holding dollars watches their wealth erode. The second asymmetric position is understanding that the ComEx delivery ban is not unique to silver. It's a template. When the system faces supply stress in any physical commodity, the exchange response will be to restrict retail access while maintaining institutional access. They did it in silver. They'll do it in copper if industrial demand overwhelms supply. They'll do it in platinum if automotive manufacturers can't source metal. They'll do it in any market where paper claims exceed physical availability. The pattern is now established, and the pattern says that retail, the individual, the non-institutional participant, will be locked out, while the institutions that need physical supply to maintain operations get priority. The asymmetry is in front-running that pattern. Position in physical before the delivery restrictions are announced, because once they're announced, the premium between paper and physical explodes. Silver was $98 on Friday before the ban. It's $119 on the screen Wednesday, but $154, $164 all-in for physical. That $35, $45 premium is the cost of not acting before the restriction. The next commodity that faces delivery restrictions will have the same premium explosion, and the people who wait for the restriction to be announced before acting will pay that premium. The third asymmetric position requires understanding what the Fed's balance sheet expansion means for inflation over the next 12 months. The $840 billion created this week does not immediately show up in consumer prices. It flows into financial markets first, into bank reserves, into asset prices. But over time, that liquidity filters into the real economy. Banks lend more, corporations borrow more, spending increases, and prices rise to reflect the increased money supply chasing the same amount of goods and services. The lag between money creation and consumer price inflation is typically 12 to 18 months, which means the $840 billion printed this week will show up in your grocery bill, your rent, your health insurance by mid-2027. The asymmetric play is in assets that historically outperform during inflationary periods: real estate with fixed-rate debt, commodity producers, companies with pricing power and hard asset backing, not growth stocks dependent on low interest rates, not bonds whose fixed payments lose value as inflation rises. The positioning needs to happen now, while the inflation is not yet visible in consumer prices, before the market collectively realizes that the $840 billion was not a temporary liquidity injection, but a permanent debasement that will show up everywhere eventually. Here is where we are stated with the precision the data permits. Saturday, February 15th, ComEx banned retail silver delivery. I warned you in that video that they were locking exits. Tuesday, February 17th, the repo market seized. SOFR spiked to 12%. Treasury collateral was rejected. I showed you the cardiac arrest in real time. Tuesday night to Wednesday morning, the Fed expanded its balance sheet by $840 billion. $500 billion went to the ECB via swap lines to bail out an unnamed European bank. $340 billion stayed domestic for repo operations and bank liquidity. The expansion was not announced. It appeared in internal Fed data that my source accessed. Gold moved from $2,147 to $3,150 in 48 hours, a 10% gain reflecting the debasement. Silver moved from $108 to $119 on paper, but $154, $164 all in for physical, confirming the paper-physical disconnect. The sequence was deliberate: ban retail delivery, seize the market, print the money. The people who orchestrated that sequence knew what they were doing and why. And the people who listened when I warned you about the ComEx ban on Saturday were positioned before the $840 billion hit the system. The ones who dismissed it as fear-mongering are now paying $154 for silver that showed $98 4 days ago. This is John A.G. I told you on Saturday they were locking the doors. Tuesday I showed you the plumbing broke. Wednesday morning the reason is undeniable. They printed $840 billion in the middle of the night. They bailed out a European bank with $500 billion while Americans slept. Gold broke $3,150 as the market's verdict on dollar debasement, and every dollar you hold just lost 3.5% of its purchasing power in a single week. The window to convert paper into hard assets is closing, not because the system is going to collapse visibly, because the system is going to be saved repeatedly with money printing, and every time they save it, your dollars are worth less. Subscribe immediately to track the next stage of this operation, because the $840 billion was not the last print, it was the first, and the people who wait for mainstream financial media to explain what just happened will be 6 months too late. The crisis was contained with debasement. The debasement is the wealth transfer, and if you're not positioned in assets that cannot be printed, you're on the wrong side of that transfer. This is John A.G., and the printer is running right now.